This is Macro Horizons, episode 350, The Grand Reopening, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of November 17th. The federal government has officially reopened, and the BLS has restarted data collection for November, leaving investors to conclude that what happens in October stays in October. Alas, try telling that to 1929. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most notable macro development was the fact that the U.S. federal government has ended the shutdown. The government restarted operations as of Thursday, the 13th of November, and that includes the BLS. The market is now very much in wait-and-see mode for the incoming releases as the BLS makes the final decisions on releasing the data. We also saw a couple interesting shifts in correlation for the Treasury market. Specifically, we had been, during the overnight session at least, taking cues from developments in other markets, most notably the gilt market, as the British budget story continued to be relevant. Moments in which we had seen upward pressure on British yields translated through to weakness in Treasuries as well. That correlation broke down on Friday, presumably because another correlation took over, that being between weaker equity prices and lower Treasury yields. Admittedly, the equity market remains near record highs, and so the 2 or 3% correction off the peaks that we've seen doesn't provide the hit to the wealth effect that would warrant attention either by monetary policymakers or investors from a broader perspective. It is something of a referendum on the AI boom story, but at the end of the day, equity valuations remain lofty enough that we struggle to envision this becoming an impact on the real economy, at least not for the time being. It certainly won't factor into the Fed's decision on the 10th of December. In terms of a probability of a 25 basis point rate cut in December, the market has now ascribed effectively even odds to either a Santa pause or another quarter point cut. All else being equal, we will remain in the 25 basis point rate camp unless the data dictates otherwise. We certainly find ourselves sympathetic to the rhetoric coming out of the Fed, which for all intents and purposes has allowed both the doves and the hawks to have a say. Now, as is so often the case, it's a challenge to translate the competing Fed speak into a coherent bias for the upcoming meeting. Moreover, one of the key aspects of the messaging has been that while a December rate cut is not a lock, forward monetary policy expectations remain very much in the mode of being data-dependent. So as the BLS plays catch-up and provides some of the missing data, we anticipate that both monetary policymakers as well as investors will have a much higher conviction stance as to what to expect in December. Let us not forget that we are reaching the point in the Fed nomination cycle that the president should, presumably by the end of November or early in December, announce who he intends to nominate to replace Powell. Our operating assumption remains that whoever the incoming Fed chair is will, almost by definition, bring a more dovish bias to the committee in 2026. So even if we don't get a 25 basis point rate cut in December, the committee will be more dovishly skewed in the year ahead.
Well, we are open for business. And now that the longest government shutdown in American history has come to an end, the market's next question is how long it's going to be until we start to receive some economic information that we have been devoid of since October 1st, and more importantly, what it means for the broader outlook and the Fed given that the FOMC has also been flying relatively blind in terms of the performance of the economy over the past month. Yes, we've had ISMs and ADP, and let's not forget Revelio, but the benchmark measures of NFP and CPI will continue to serve as Powell's guide in determining the likelihood that the Fed will continue the easing campaign next month. As it presently stands, a cut is more or less priced to a coin flip, and while if we had to choose, we expect that we will get another 25 basis points in December, it is certainly not the foregone conclusion that it once was. And while the growth hit for Q4 and what that means for GDP won't be revealed until early next year, that also will play a role in determining how consumption fared and how the broader economy held up during the government shutdown. Obviously, as a share of broader growth, the government is relatively small, but especially at this point in the cycle when the labor market was already on the back foot, any more downside economic information takes on a slightly different character at this point in the cycle.
It's also interesting to note that a mid-November reopening of the federal government is probably the best case scenario, if we were going to have the longest shutdown ever, for the first and second quarter of next year, restarting on a relatively clean slate from an economic perspective. Yes, we will have questions about data quality in November, with presumably December being back to some version of normal, and then presumably by Q1, the BLS and markets will be functioning as usual. Let us not forget there are also other lingering uncertainties, not least of which being how the Supreme Court comes down on Trump's tariffs. We have no specific timeline for this information, although, as the justices continue to debate, this will remain a looming overhang, as it were, for the market. There's also the uncertainty regarding who Trump will nominate to replace Powell. Bessent has said that the timeline for the announcement is sometime after Thanksgiving and presumably before the new year. Now, this is very consistent with the timeline of prior nominations and would set the incoming Fed chair up for confirmation during the first quarter with their first live meeting in June. And when we put this in the context of whether or not the Fed chooses to pause in December, it's important to keep in mind that whoever the next chair of the FOMC ends up being, the assumption is that they'll be biased more dovishly, and any pause on the way to neutral policy rates will be made up sometime in 2026. One could also argue that the same logic should apply to the dot plot. However, in light of the presumed independence of the estimates, one should take at least the 2026 dot as a reasonable departure point for expectations.
And from the perspective of the outright level of yields, following the October FOMC and on a relative basis, Powell's hawkish comments versus what had been a more aggressive easing path going forward, before the chair talked back that pricing, we now have 10-year yields and, frankly, the yield curve more broadly in an increasingly well-defined trading range that we'll call roughly between 4% and 4.25. Yes, we've briefly probed below 4%, and it's not unreasonable to expect an episode of bearishness that might put a challenge of 4.25 on the table. However, for the time being, rate volatility remains very low as the market and the Fed continue to hold in wait-and-see mode. Now with 10 still comfortably above 4%, we continue to favor buying backups in yields as opposed to selling rallies below 4%, simply given the fact that in addition to the changes of leadership at the Fed that will be coming next year, we also have the longer-term trajectory of the labor market that was set long before the government shutdown, and we expect that the Fed is going to lean more heavily on the longer-term trend, so a perspective rooted in quarters, not month by month, is going to dictate monetary policy action. And while we've heard from many Fed speakers over the past week that have repeated Powell's messaging that December is not a foregone conclusion and upside risks to inflation remain, even if the Fed doesn't cut in December, the longer-term easing bias remains intact, and at this point it's extremely unlikely that we've realized the last cut of the cycle. After all, even the more hawkishly inclined on the FOMC will acknowledge that neutral is still somewhere below current levels and that monetary policy is restrictive. And so, given the concerns on inflation, while a return to accommodative territory might not be necessary, the concerns on the labor market means that something a little bit close to neutral and not quite so restrictive is probably going to be appropriate to be reached at some point in 2026.
And the counterargument to whether or not we should see a reacceleration of growth and inflation expectations comes down to this notion that the administration instilled a great deal of uncertainty from the perspective of participants in the real economy. Business leaders and hiring managers have been reluctant to add employees, given the fact that Washington continues to change the rules and it's difficult to know when and where to expand. The path towards a reacceleration of growth and indirectly inflationary pressures comes in the form of a more stable outlook for 2026. Said differently, in the event that the trade war dust settles and the tensions between the U.S. and China and Canada and Mexico
and India
are ultimately resolved in a way that business leaders have confidence in hiring and expanding, then we might see the first half of next year characterized by a stronger labor market, which in turn would reinforce not only the trajectory of broader growth, but also presumably be accompanied by a leg even higher in equity valuations. The one wild card here is that if employment picks up, as you point out, Ben, there will be less of an incentive for the Fed to get back to the neutral policy rate.
And along with the shutdown, the legality of tariffs, and the ongoing trade negotiations that continue to reshape the global economic order, we also heard a little bit about SOMA's plans for the balance sheet at this week's Treasury Market Conference. Specifically, Roberto Perli's comments that the Fed will probably start asset purchases before too long. And while we'll get ahead of this conversation by saying it's not QE, that won't prevent plenty of market dialogue on the topic, it's not unreasonable to anticipate that at the December FOMC or at some point later this year, that more formal communication is laid out to set the parameters around the Fed beginning to grow its balance sheet once again via bill purchases in the secondary market. Remember, this is similar to what we saw in late 2019, where the Fed bought bills for the purposes of reserve management, and we're expecting a relatively similar framework will be the departure point for whatever comes to pass either later this year or in early 2026. Unlike a QE program whose goal is economic stimulus and keeping long-end rates as low as possible, reserve management purchases will do exactly what they sound like in terms of targeting a level of bank reserves in order to prevent a slip too far below the abundant to ample threshold and prevent any funding market stress going forward. And so, taken with the refunding announcement that said bills are near the frontier of what's appropriate in terms of overall size, and the fact that on December 1st, the Fed will start reinvesting MBS maturities into bills, along with balance sheet expansion into the bill market, from both a supply and demand perspective, we're increasingly constructive on the very shortest part of the Treasury curve. Now, does this mean anything for 2s, 10s, or 5s, 30s? Probably not. For that, we will need to wait for what will still be characterized as stale or distorted data. But nonetheless, as 2026 outlooks are finalized, it's safe to say that Fed balance sheet expansion is going to be a feature of the Treasury market next year.
In translating the actions in the very front end of the curve further out to 2s, 5s, 10s, even 30s, it is somewhat counterintuitive that in the event that the Fed is successful at avoiding a funding strain or any stresses in the very front end of the market, that removes a potentially bond bullish impulse further out the curve. So, as you point out, Ben, while the front end of the market may remain well contained, the 10 and 30-year sectors in particular will be allowed to more freely respond to the evolution of the real economy. Whether we see a reacceleration of inflation and growth expectations will dictate the degree to which longer-term rates can back up. But if nothing else, the overall stability witnessed in the Treasury market during the trade war implies that concerns about a wholesale buyer strike in U.S. Treasuries or the asset class's loss of its safe haven status have been eliminated as major concerns. We, for one, are happy to see the Treasury market once again return to trading the fundamentals, for better or for worse.
And it might be for worse.
Not if you're long. In the week ahead, the market will be focused on any official data coming out of the BLS, as well as the FOMC minutes for the most recent meeting. The FOMC minutes should expand on the debate within the committee as to the prudence of the 25 basis point cut that was delivered in October, as well as a prospect for cutting in December. Now, clearly there has been a fair amount of debate between the doves and the hawks on the committee, so it will be notable to see the degree to which the minutes outline the details of those two positions. In addition, any discussion around the decision to end QT on the 1st of December will round out the market's thinking on what to expect from the balance sheet going forward. There's an active debate as to when and if one should expect reserve management purchases to come back into play, simply to ensure that reserves remain in line with the ample regime narrative. We will also see a continuation of the discussion around the forward use of the balance sheet, which as a baseline does seem to be on the table, although implicitly there is the assumption that the Fed needs to bring policy rates back well below neutral before a conversation about true QE comes into play. All that being said, the Treasury Department's decision to focus on issuance in the very front end of the market does complicate matters for the Fed, although using reserve management purchases to fine-tune what's going on in the financing market certainly does resonate, and the details of that are likely to come out over the course of the next few months. It's also worth noting on the September non-farm payrolls release, recall that this data was collected during September. It's typically the week that contains the 12th of the month, so long before the government shutdown. In addition, it was originally scheduled to be released on the 3rd of October, so by and large, there should be no data collection issues. The more important concern is the interplay between the private data and the BLS data. Recall that even ahead of the government shutdown, the BLS methodology had been criticized, to put it mildly, given the magnitude and the frequency of the revisions. The fact that the BLS data was then subsequently revised to fit the ADP data more closely indicates that the ADP series has increased, at least for the time being, in relevance. When we put this in the context of the September BLS data, we already have the October ADP data, and therefore we suspect that the looming release of the official September employment report brings with it less conviction in terms of trading than might otherwise have been the case. This all reinforces the range trading thesis for the next week or so as we look forward to more current official data going forward. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the data schedule fills out, investors will return to their pre-data rituals: caffeine, angst, and camaraderie. We're all going through this together. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.